11%. That's the magnitude of the sudden plunge Broadcom shares took today. And this was despite the company actually delivering a remarkably strong earnings beat. The AI market has felt like a seemingly unstoppable force lately, but today we're definitely witnessing a critical shift in momentum.
Hello everyone, welcome back to AI Market News. Today we're analyzing the shockwaves moving through the global indices and asking what's really on everyone's mind. Is the AI trade fundamentally changing its trajectory?
Section 1. Broadcom breaks the AI rally. Let's examine exactly how Broadcom sent ripples through the entire semiconductor sector. Now, on the surface, the company's performance looked excellent. Their fiscal second quarter AI revenue hit $10.8 billion, and earnings per share easily beat expectations. But here's the catch. Management chose to keep their 2026 and 2027 forward guidance totally flat at just over $100 billion rather than upgrading it. So why does this matter? Well, tech valuations rely heavily on aggressive future growth. When high-flying companies don't raise that forward guidance, the market immediately interprets that caution as a hard ceiling on growth. And that triggers sharp sell-offs, completely regardless of how good the current profits are.
Section 2, Sector Rotation and the Dow. This single event really catalyzed a broader shift in market positioning for all of us managing diverse portfolios. As you can see in the chart, there's a stark divergence playing out right now. The Nasdaq has trended lower under the weight of this tech sell-off, while the Dow Jones actually climbed to a record close of 51,562. The underlying mechanism here is sector rotation. When investors feel tech valuations are getting just too stretched, they pull their capital out of those growth stocks and rotate it directly into traditional defensive value stocks. They're basically seeking safety while making sure their money stays in the broader market.
Section 3. Japanese market and currency. Pivoting the focus to what this means for all of us tracking the Japanese markets, the graph shows the U.S. 10-year Treasury yield, 10-nen Sairimawari, pulling back just a bit to sit near 4.47%. This yield essentially acts as a gravitational pull for global finance. It sets the baseline for borrowing costs worldwide and directly influences our global currency valuations. Connecting that yield to our local economy, the graph shows the USD/JPY, dollar-yen, daily chart trading right near the 160.02 level. The mechanism driving this is pretty straightforward. The USD/JPY pair is primarily dictated by the interest rate gap between the United States and Japan. Because US rates remain significantly higher, capital naturally flows toward the dollar to capture those better returns. This means any fluctuations in US Treasury yields directly and immediately impact our currency's exchange rate. Based on available data, the weakness we're observing in US megacap tech naturally creates headwinds for our domestic equities. The tech-heavy Nikkei Heikin Index relies heavily on semiconductor and electronics manufacturing components. So a slowdown in US tech momentum very often triggers cautious, sympathetic selling right here in Tokyo.
Section 4, May Jobs Report Showdown.
Looking at the immediate timeline, we really need to prepare for the most critical intraday catalyst today. The May NFP Fei Nongyo Bumen Koyosa suit data drops tonight at 9:30 p.m. Japan Standard Time. We're essentially watching two distinct scenarios play out. A weak print, say below 85,000, could drive hopes for a rate cut, which would offer a much-needed lifeline to tech stocks. On the flip side, a strong print above 115,000 cements expectations that the Fed will hold rates steady. The key mechanism to remember here is that a strong jobs report signals a robust economy, which in turn delays any interest rate cuts. Those prolonged higher borrowing costs then place direct downward pressure on the valuations of our tech stocks. Section 5. The macro setup ahead. Shifting gears to look at the broader economic calendar, according to current market information, we are entering a truly massive week. We'll see the US CPI, Consumer Price Index, release, which measures core inflation, followed immediately by a highly anticipated and reportedly internally divided FOMC meeting. These specific data points will dictate global liquidity and heavily influence both US and Japanese trading floors.
Section 6, Economic Calendar and Summary.
Let's begin wrapping up this explainer by tying all these macro and micro elements together.
To summarize the economic calendar, that 9:30 p.m. JST NFP data is our immediate focus, followed by CPI, inflation risks, and potential FOMC surprises next week. Furthermore, the market is going to have to absorb the massive $1.75 trillion SpaceX IPO. The mechanism at play with an IPO of this sheer magnitude is market liquidity absorption. When a single company commands $1 trillion valuation, strategists start drawing parallels to the dot-com era. They're watching closely to see if the market actually has enough capital and risk appetite to sustain such immense price tags. We leave all of us with a final thought-provoking question to consider. With Broadcom's stagnant forward guidance and shifting sector rotations, is the AI infrastructure trade finally maturing from a period of blind euphoria into a phase of fundamental reality?
Thanks for watching. Please subscribe and hit the like button. This video is automatically generated by NotebookLM AI. AI-generated content may include errors. This video does not constitute investment advice. For full details, please check the description below.